complex as it can be. What we're here to talk about today really is the government takeover of Fannie Mae and Freddie Mac. And at the heart of this takeover is a policy known as the net worth sweep. So I sent out this slide earlier today. And really what I'm hoping to get from it is the idea that this net worth sweep truly is a dividend renegotiation. And it's a dividend formula that's set equal to the greater of the company's positive book equity or zero. What that really means in layman's terms is the driver of book equity are a company's profits. So really what you're doing here is sweeping all of Fannie Mae and Freddie Mac's profits, if they have any posted, that's shipped as one big dividend to the Treasury Department. If there are no profits posted, then there's no dividend obligation. And really what this policy does is it nationalizes the GSEs or government-sponsored entities. And based on lawsuits and the way the courts have ruled so far, non-government shareholders have no recourse or say in this policy or this matter at all. In fact, the courts have ruled in such a way regarding the net worth sweep that the FDIC can impose a net worth sweep on a depository institution at some point in the future during a conservatorship. And I have a slide to detail that proof out. What I really wanted to highlight, though, are these three key takeaways. Number one is the FDIC as conservator can impose a net worth sweep on a depository institution based on SCOTUS's ruling in Collins versus the FHFA. And then the key is if they can impose this net worth sweep and truly take 100% of a company's profits, they can also do this without a takings claim. That's where Fairfield versus the US comes into play. The second key takeaway I wanted to address here is how exactly do you justify instituting a policy that sweeps 100% of an entity's profits? Well, number one, it's really rooted in this accounting and the complex accounting principles and rules that govern the GSEs. From 2008 to 2011, what I argue is the FHFA, the conservator of the GSEs, really in fact weaponized the firm's financial statements. They twist a lot of rules and principles, and I'll go over at a high level, and then we can maybe do more in Q&A. But they twist these rules and principles for the government's narrative, which is the GSEs are hopelessly insolvent. They require a lot of bailout funds from the Treasury Department, and that they're really a ward of the state, essentially, and kept under the government's thumb. Consistent with this theme of being kept under the government's thumb, the third key takeaway here is regardless of the original intention to wind down these entities, and what I mean by wind down here is you seem to have these tones at the top of these really powerful government figures that despise the GSE's private shareholder public mission business model, and they wanted to eliminate that, carve up. If you read the thesis, you might notice there's a quote from Secretary Geithner that says, we can either dismember, carve up, or sell off bits and pieces of the GSEs. He said that during the Starr case, which regards AIG. That's what I mean by wind down there. But regardless of that original intention, really keeping the companies in conservatorship allows the current administration to politicize their operations. I don't know if you guys have seen the recent news, but starting May 1st, homeowners are going to be penalized if they have a good credit score, which means the higher the credit score, you're going to pay a higher mortgage cost and you're going to subsidize lower for people with lower credit scores. That's something the Biden administration has had Director Sandra Thompson, the current director of the FHFA Institute, and it's coming about May 1st. And if it seems a little bit un-American, well, the whole thing with the net worth sweep should kind of ring that bell. In terms of my thesis outline, I divided it into 4 parts. So there was the background and the history, which I know can be kind of extensive, and hopefully I give you a quick high-level summary of what's going on there. The second part is the weaponizing of the accrual accounting. The third is the net worth sweep actually nationalizes the GSEs. The fourth is concluding all the pieces together and how the FDIC can impose a net worth sweep on depository institutions. And then a fifth section that I included for this presentation is maybe areas for further study or where you can go with this research. When it comes to the background and history, well, I started off with like the birth of Fannie Mae and Freddie Mac. Why exactly did they come about? Fannie Mae started kind of with FDR's vision to resuscitate the American dream of home ownership coming out of the Great Depression. Fannie Mae was originally a government agency. What they would do is buy up all these mortgages because the originating banks had an asset liability mismatch. And that's exactly how you spawn a 30-year of prepayable fixed rate mortgage. It's really having this government agency coming in and guaranteeing them and securitizing them and selling them off, guaranteeing interest and principal payment. Then you get to the late 1960s, Fannie Mae has significant debt on their sheets, The government doesn't want to consolidate this on the federal balance sheet. So what do? They spin Fannie Mae off as a private shareholder owned business. And then in 1970, you create Freddie Mac, which is like the sister, the cousin, to provide competition there. For decades, the GSEs provided liquidity to the secondary residential mortgage market. And another key factor I want to talk about is this implicit guarantee. So because they had a congressional charter, Fannie and Freddie, the idea was market participants believed that these two GSEs would be saved by the government in the event of a default. As a result of this implicit guarantee, you had cheaper borrowing costs and increased profits, which when you compare to the financial establishment is absolutely critical. And when we're talking about Fannie Mae and Freddie Mac, half of the mortgage market, residential mortgage market, translated into huge profits. Another key factor is there was a lot of foreign investors in the GSEs. And this is going to become very key when it comes to 2007, 2008, the housing crisis. When housing prices were declining, there was a fear of a Fannie and Freddie default. All of those foreign investors could go under with Fannie and Freddie. So that's where you see a proactive Congress come in and enact HERA, the Housing Economic and Recovery Act, which borrowed a lot of language from an act called FREA, which defines the FDIC. I go into that a little bit later. But what HERA did was it created the Federal Housing Finance Agency, the FHFA. And what the FHFA did was put Fannie and Freddie into conservatorship on September 6th, 2008. A day later, they entered into Treasury into a preferred stock purchase agreement, which allowed Treasury to inject funds into the capital structure of Fannie Mae and Freddie Mac. I then go into the thesis about the death spiral narrative. I go into how they weaponize the accrual accounting. And again, I'll give you a high-level summary of that a little bit later, but we can discuss more about that in Q&A. When it comes to weaponizing accrual accounting, what I really mean is the twisting of accounting principles and rules to the exclusive benefit of the government's narrative. And to further unpack the accounting, there were these two lawsuits that didn't go after the FHFA or the government itself. They went after the auditors, PwC, which is to Freddie, and Deloitte, which is to Fannie. And what they said was, auditors, you certified materially misstated financial statements, and you have liability for doing that. There are 4 high-level accounting topics that we can go into during Q&A, but there's the allowance for loan losses, rep and warranty putback receivables, FAS 133 derivative accounting, and then there's the ultimate deferred tax asset valuation allowance. Again, a lot of that we can unpack later on. But really what you get with these non-cash expenses during 2008 and 2009 and 2010 is really this sharp drop off in net income. That's what's going on here. And then when the housing market starts to rebound and things are looking a little bit better, guess what? You can start to flip the switch and reverse all those accrual accountings. And a lot of the internal memos that I detailed in the thesis talk about how these Treasury officials, these FHFA executives, they were aware that these huge reversals were coming about. So what do you do right before then? You enact the net worth sweep. Why? Because we're going to sweep 100% of these accounting profits when they get reversed back up. And that's exactly what this graph shows. In fact, Fannie Mae at $84 billion is the 4th largest ever corporate annual earnings of all time. I believe only beat by Vodafone and Aramco for 2 years, Aramco. So once they enacted the net worth sweep, really what this did was it nationalized the companies. And to rely on this, I use a doctrine known as the substance over form doctrine. What this doctrine really states is you should really analyze the economic substance of a transaction rather than its legal form. The IRS uses this day in and day out when it comes to auditing taxpayers. Why? Because a lot of taxpayers will, oh, let's do this structure. Let's try to manipulate a structure in this manner to avoid the taxes. IRS says, no, none of that. We're going to go and look at what the actual economic substance, the actual ownership of the company. I believe that same doctrine applies directly here. Why? Because legally, the form of the net worth sweep is that renegotiation of the dividend formula from a fixed 10% cash to 100% variable of all the profits. Why? It solves that circular draw, that death spiral narrative. Economically, however, you've just essentially taken all the residual value, which is a defining feature of common equity, and basically shoved it to the senior preferred equity holders. What does this do? It absolutely trashes the value of, in fact, it absolutely destroys the value of anything subordinate to where that residual value flows, i.e. the junior preferred, the common shareholders, all those non-government shareholders. The one other little aspect to this to complete a full nationalization is HERA's succession clause. One of the things there was when you go into conservatorship, As a common shareholder, as a junior preferred shareholder, you lose a lot of rights, but you don't lose everything. You don't lose the right to your liquidation preference. You don't lose the right to potential recovery, potential dividends. You'd have to go through a formal bankruptcy to actually impair and wipe out those securities. That's why when someone says, oh, were those securities actually impaired in 2008? I'd argue no, because we went through and did a lot of the accounting in terms of the cash net income at that time. But also they never went through that formal process to actually wipe out the securities. So implicitly, they could participate in a potential roaring recovery, as we saw in the net income slide. However, the net worth sweep usurps that entire idea and really seizes all the profits for Treasury themselves. So how does this tie together with the FDIC? Well, what I said before is it really comes down to these two laws, HERA and FERIA, and there's something called the best interest clause that's inserted into each of them. So I believe FERIA was enacted in the late 1980s, 1989, if I believe, and HERA was enacted in 2008. Well, FERIA governs the FDIC and all of the FDIC conservatorships. So it makes sense when lawmakers need to put together a law real quickly in 2008, they're going to borrow a lot of the language from FERIA. That's exactly what happened here with the best interest clause. So with FERIA, the corporation, the FDIC, may as conservator take any action authorized by this act, which the corporation determines is in the best interest of the depository institution, its depositors, or the corporation. Similarly with HERA, you have the same structure, same everything, except you say of the agency, or the agency, which is the FHFA. Well, when it comes to challenging the net worth sweep, it's not really an action a conservator would take. A conservator is known through FERIA, is known through the FDIC precedents to preserve and conserve assets. You'd want to really think about, like, would you really ship off all the assets, especially at a time when you know the inflection point is coming, when internal FHFA officials are saying there's a roaring recovery, when internal Fannie Mae people are saying their golden age of GSE earnings are right on the next 8 years of 2012. Are you really going to ship off all the assets? No, that's not what a conservator would do. So SCOTUS needs to find a way in order to redefine conservatorship. And that's exactly what they did with the FHFA here. They said the FHFA conservatorship differs from a typical conservatorship in a key respect. Instead of mandating that the FHFA always act in the best interest of the regulated entity, Fannie and Freddie, HERA authorizes the FHFA to act in what it determines is in the best interest of the regulated entity, emphasis, or the agency. Thus, when the FHFA acts as conservator, it may aim to rehabilitate the regulated entity in a way that, while not in the best interest of the regulated entity, is beneficial to the agency and by extension the public it serves. What they've essentially did right here is they redefined conservatorship to put the interests of the conservator above the interests of the conservatee, something that's never been done in the history of conservatorships. The second thing you have here is they relied on this best interest clause to swallow every other statute's meaning. And if you go through in the thesis, I have a section on the powers of the conservator clause to conserve and preserve assets, to put the entities in a sound and stable relationship. Essentially, what SCOTUS said was this best interest clause supersedes all of those clauses. And if you want to act in the best interest of the agency, of the public you serve, hey, you can get away with this net worth sweep. And this is also why the accounting is important, because SCOTUS then goes on and says this was enacted at a time when liabilities exceeded assets for 3 years, and it was enacted at a time when circular draw was going on. But we know from the thesis, a lot of those arguments just fall short if you study the accounting in depth. So connecting it with the FDIC again, if HERA has this best interest clause that SCOTUS relies on, and it's borrowed from FERIA's best interest clause, the FDIC as conservator can find a reason that it's in the best interest of the FDIC to impose a net worth sweep on a regulatory depository institution, Bank of America, JPM. It may not be too crazy with, at least with the third key takeaway here about politicizing operations. If certain people get into power with the executive branch, you've essentially legalized a way to nationalize companies without liability or takings recourse. So connecting that with the takings case, this very high level, the Court of Appeals threw that case out with what I wrote about on how they did it in an expedient manner. They relied on precedents that don't exactly deal with conservatorship and how you're about to go on a roaring recovery. They didn't rely on, they did rely on precedents that talked about imminent receivership, which was not the case with Fannie and Freddie. There's also a section I had in the takings case that talked about, well, the board of directors consented to the conservatorship, therefore everything's okay. If you go through and read that section again, you'll see Hank Paulson's book. He's bragging about how, man, we put a gun to their head, the board of directors, this wasn't a negotiation. The first sound they'll hear is their heads hitting the floor. He's talking about Fannie Mae Freddie Mac's board of directors here. And this is all in his memoir published years later. And so that handles the takings case. But essentially, because takings has been thrown out and SCOTUS declined certiorari, the ruling of the appeals court stands, and you can't bring a takings claim when it comes to net worth sweep. That's the point of that. So last section I wanted to conclude right before we open up for Q&A and kind of a Socratic method discussion. There's 3 areas of study I wanted to go into, but just didn't have the time. Number 1 is under the terms and agreements of the original preferred stock purchase agreement, you could either do a 10% cash dividend or you can elect to do a 12% PIK dividend. All of us know from Finance 101, if you pick something, you're not paying the cash, you're deferring it into the future, and that preserves the Treasury commitment, which totally undercuts all of Ugoletti's and DeMarco's narrative that the Treasury commitment was being eroded. The other thing with the PIK analysis is the dividend is tied to the senior preferred liquidation preference. That liquidation preference rose every time you drew down on the Treasury. It also rose if you picked the dividend as well. But the key was if you picked the dividend, the liquidation preference attributed to that PIK could be paid down. If you drew down on the cash, it was not repayable. That's one of the key things with the PIK that I find really egregious with management. Second area of analysis that you can go in on, there's a few remaining outstanding lawsuits. I attended one of them in October. It ended up in a hung jury, and it's the good faith and fair dealings. It's kind of what it sounds like. The government breached the implied covenant of good faith and fair dealings. How it ended in a hung jury, again, for me being so deep in the weeds is a little mind-boggling, but they're coming back for round 2 in the court in July 2023. There's also an appropriations clause that's kind of interesting. If anyone's familiar with the FCPB, the Fifth Circuit just ruled that it goes around Congress's purview when it comes to a constitutional issue of appropriating funds. The reason I bring that up is that CFPB is very similarly structured to the FHFA, and there's a lawsuit about the FHFA appropriations going through the courts right now. The last section is, you could do a deep dive on any of the accounting, but really an analysis on the GSE rep and warranty lawsuits with a specific focus on the confidential Wells Fargo agreement, I think could be really interesting. They're not listed in the formal settlements. Wells Fargo represented 10% plus of GSE business. It's disclosed in the footnotes of Fannie Mae. You got to ask the question of what's going on when they represent so much volume, why weren't they on the formal settlement? So I think you can look into any one of those areas. Without further ado, I would like to open it up to questions, and I have some slides that I thought I could anticipate for you guys, but happy to answer them.
So the one thing I'm wondering with this is obviously I don't understand the net worth sweep to a 10th of what you do, but I'd imagine if they're in a senior secured position, they have to at some point that position has to be paid off. Right? Was there any language that said how much money Fannie and Freddie have to pay before the government isn't allowed to own them anymore?
So that's a good question, and it involves the liquidation preference. Could it be paid down? I think is what you're getting at. Written into the certificate of the senior preferred, if you drew the cash, you cannot pay down the liquidation preference unless the company's exited conservatorship, and you could not exit conservatorship without express consent of Treasury. So they lock you up that way. What you're really going to need if you want to see this write down of the senior liquidation preference, I didn't go into this, but in 2019, things were changed regarding the GSEs under the Trump administration. The net worth sweep is still in effect. It's not a cash dividend anymore. It's a stock dividend. Fannie and Freddie are allowed to retain earnings, and I think they're at around 90 to 100 billion right now. What that means is I'd argue they're well capitalized. They pass all the stress tests under the Dodd-Frank Act. And because they're well capitalized, dollar for dollar with increase in retained earnings amounted to a dollar for dollar increase in the liquidation preference. So that liquidation preference is still increasing. Once Fannie and Freddie hit, I think like 200 billion in retained earnings or 230 billion, it's 4% of total assets. Then the net worth sweep kicks back in. So that's, yeah. Yes.
So first of all, I just want to say, I think this is, an exceptionally high quality piece of work. I really haven't seen anything of this quality in all the years I've been looking at undergraduate thesis. So just a very, very huge congratulations. I mean, it's incredibly well written. The analysis is, it's substantive, it's compelling. It's illuminating even for those of us who are kind of in this field. So, it just bravo. I found it really interesting. I've been reading it over the past couple of days, and I guess I have kind of a higher level question about the political economy of this process. So if you were to listen to your story and get to the punchline, you would conclude that in the political economy of this process, certain interests in the federal government had disproportionate power because the outcome was shaped in their favor. Normally how these things get negotiated is through, some kind of interaction between opposing forces of lobbyists, right? So my question is really, who's on the other side? What were the levers that they used to try to influence policy? Why did they fail? So kind of dramatically. So, where were the institutional shareholders? Where was the, American Bankers Association? I mean, all these folks that are usually very active.
Yeah, so a lot of institutions, smaller end banks were invested in junior preferred securities. In fact, there was an issue called FNMAS that was, I think, 3 or 4 months before conservatorship was imposed. It's a 25 face that, again, issued probably at around 25 and then was trading at around $1 to $2 at the end of 2008. Some of those banks got absolutely wiped out within the next year because they put their money into Fannie and Freddie thinking it'd be safe at the junior preferred level with the really nice coupon or dividend payment. But they just didn't anticipate the conservatorship being imposed and their value essentially being wiped out. Where I'm going with that is a lot of those banks filed lawsuits trying to overturn the net worth sweep, and they ultimately failed. And I would argue it's because a lot of the judges, not all of them, and I'm generalizing with this comment, but a lot of the judges seem to miss the mark on, I would say, weaponizing the accrual accounting. Because what it really comes down to is the net worth sweep was imposed to solve the circular draw problem, to solve the death spiral narrative. That's rooted in all the egregious accounting, all the non-cash write-downs, and then eventually a write-up after the net worth sweep was imposed. So a lot of these banks and a lot of the people invested in Fannie and Freddie were betting on the judiciary seeing through the fog of weaponizing accrual accounting. Some of the judges did. A lot of these court cases are 2-to-1 in the appeals level. They're like, they were fractured at an en banc Fifth Circuit ruling. But ultimately, I would argue the politics outweighs the accounting, outweighs the economics behind this factor. Did you want me to go a little bit more philosophical with the whole net worth sweep, or did that answer your question?
So I guess, what I'm trying to get my head around is, was there, so you're saying there were lawsuits, but was there kind of an organized political lobbying response?
It was called Investors Unite. It was led by Bruce Berkowitz, a lot of fund managers who saw the net worth sweep and said that, and a lot of like at Cooper and Kirk, the DC headhunters here that go after the government, the lawyers. They formed an organization called Investors Unite that's like kind of been disbanded after SCOTUS ruled with Collins, because that just absolutely demoralized the community. But there was a huge lobbying effort between 2013 to 2015. I'd also say between 2013 and 2015, consistent with this idea of wind down, you had Senators Bob Corker proposing models to do GSE reform and potentially eliminate the GSEs altogether. If you want to go into the lobbying efforts right now, what could be interesting to unlock the value of the GSEs is Treasury still has these warrants for 80% of the common equity, but obviously no funds flow through the senior preferred. what you'd have to do as an administration to get because these are funds that you can get from Treasury, not through Congress, and that's key when you have a Democrat president in power and you have a Republican Congress that decides their budget. Presidents want money and they want Congress to give it to them, but right now you have conflicting parties there. So what you would do is you'd have to declare the senior preferred fully paid from the net worth sweep, which I would argue it has been. The government has made over $400 billion in this deal after putting 191 down. You would declare that paid and then exercise your warrants. What that means is you have to share with the junior preferred shareholders. And I put a disclosure at the beginning of the thesis saying I'm an investor in that. It's precisely those economic incentives that I think will somehow a political administration will wake up to those economic incentives and access the common equity funds. And to do that, you have to go through the junior preferreds, and that's why I invested in.
Well, first I have a correction. Very early on, you referred to the Fairholme case and you said Fairfield. I just want people to know I don't have enough money to sue the government. But my question is the parallel that you're making with the FDIC, have you seen that elsewhere, echoed elsewhere?
The net worth sweep itself or the actual parallel?
The parallel between the two charters and the nationalization, basically. And what I'm getting at is, I suggested you write an op-ed. I'm wondering if this is kind of known or if this is something that you've picked up.
If it was more known, I'd be in, I'd probably talk more than I already do, but I will say going to the jury trial, there's a lot of nutheads like me out there that really dive into this stuff. So I'd say within the GSE community, it's well known. Outside the GSE community, there's a lot of people like just don't even know about Fannie Mae, Freddie Mac in general. These guys are the wheels behind the residential mortgage market and allow mom and dad to go get a mortgage more easily and at a cheaper rate. So I would say this isn't well known at all.
Anthony, you in agreement with Patty and Pietra, you've woven a masterful sort of story about here with Fannie Mae and the nationalization of this company. You backed it up with legal arguments, but got into the roots of the accounting. I'm in a unique position because I used to work there. I spent several years and the area I worked in was FAS 133. And we set up the systems by which we would comply with hedge accounting and their massive derivatives portfolio. And during the time when I worked there, there were very few accountants in America from the top firms that actually understood FAS 133. This is difficult accounting, and what you relayed in your paper was a masterwork in terms of sort of dissecting and decomposing these very difficult to understand and somewhat esoteric accounting principles and laying bare how the government sort of engineered an outcome that they desired, both through the elevation of their priority in terms of the stack of priorities and sort of subordinating the interests of the common shareholder. You also brought forward a very interesting and important constitutional argument that there are two issues that are being sort of abridged here. One of them is due process, and the other one is, is also in terms of due process, in terms of shareholders not being informed that they were going to get flushed, as well as an equal protection, constitutional issue here in terms of the rights of the shareholders vis-a-vis, the preferred, as well as, the governmental entities that were involved here. This is difficult accounting, but I think you made a very, very cogent, argument that this is in fact de jure, not a nationalization, but de facto, based on, if you look factually, what's happened here is a taking, certainly at the expense of the common shareholders.
And that's how the investors kind of structured their two lawsuits. Collins was going to say, hey, look, if you're going to enact a net worth sweep as a conservator, or what Collins said was, if you're a conservator, you're not going to enact a net worth sweep, and therefore you're outside the realm of a conservator's powers. and you vacate the Third Amendment, the net worth sweep. Or fine, a conservator can do that, but now it's a de facto takings, and in both cases, it was a bang bang to shareholders, and yeah, I don't think the ramifications are good for future investors in obviously the GSEs as well as depository institutions.
Just, I guess more on the high level philosophical, I think of recently with the FDIC and the systemic risk exception with, the two banks that failed and kind of interweaving a little bit more of the political economy of what the government's role is when there's potential for economic contagion. What if the government never put Fannie and Freddie into conservatorship? How would the accounting flow through, or what kind of ramifications would you see there?
It's a great hypothetical, and so that I'm going to divide that question into two parts, which is 2008 and 2012. 2008, Fannie Mae itself was reporting operating positive cash flows. And so when justification for the conservatorship, which isn't necessarily the full focus of this thesis, when that comes out, what you did was you wrote off all the DTAs in Q3 2008 as soon as you were a conservator, and that justified the narrative of insolvency, utter unprofitability. And that allowed for the government to really plant their claws into Fannie and Freddie and then do further accounting manipulations in that regard. So that's the 2008 narrative. When it comes to 2012, all of these accountings are about to be reversed. And the key thing there is you can kind of look in hindsight as 2020, but when you start looking at those internal memos and people on the desks of the GSEs and of FHFA, they have data that you don't have, that the public eye doesn't have scrutiny to. That's the key data you have to understand here. Treasury's looking at this and going like, oh my God, it's going to be a windfall. Oh my God, we're going to have debt ceiling problems in 2013 is a perfect time. Oh my God, the housing market's coming back online and GSE profits are going to go through the roof. That's all the key aspects when it comes there. It really is rooted in the accounting, I would say. And a lot of people, as Professor Dong mentioned, just very tough to miss the mark. But at least in this thesis, what I tried to do was, hey, look, there's credit risk, there's default risk, which are the same thing. There's interest rate risk, and then these are the protections Fannie Mae Freddie Mac had. And then this is how the government twisted it, specifically for the derivative accounting. They elected to remove the hedging designation altogether. And what that did was just unlock the flow of derivative losses without the underlying MBS gains, mortgage-backed security gains, to offset them, and it just showed a depressed net income. You can then.
So kind of a question getting into the accounting. So understand, the liquidation preference rose dollar for dollar off of drawdowns, right?
Yes.
And so what originally were huge losses, non-cash losses in 08 off of write-downs on their mortgage portfolio were non-cash. And so my question is, those reversals that took place in 2013 were also non-cash. So how were those funded? Because you mentioned here, there was a huge distribution after they returned to accrual-based profitability, but how were those distributions funded?
Okay, yeah, I only learned about that at the jury trial. So when you post for Fannie 84 billion in 23 and for Freddie 60 billion, I think was the number. How do you fund $130 billion when companies typically don't have that cash on hand? The GSEs actually had to go to the debt markets and issue funds there. So they increased their liabilities to pay a dividend to the senior equity holders, which is the Treasury, which is an absolute slap in the face to the definition of a conservatorship, of preserving and conserving assets. You're increasing your debt load just to ship off the cash to a senior preferred equity holder. That's how you fund $130 billion of artificial accrual gains.
That makes sense.
If you can go to that Collins court case, I would love to hear a little bit more about how the Supreme Court kind of ruled that because it benefits the agency, how they reason that because it benefited the agency, that's benefiting the public, maybe more so than benefiting, Fannie and Freddie specifically, and therefore the public who is invested in the common equity and the prep equity.
So it's really rooted in this idea of circular draw. And the way you commit a draw is when your net assets or your book equity is negative. Then you have to incur a draw. Otherwise, it's mandatory receivership under HERA. So that's the rule there. What the GSEs were actually doing it, and this is the FHFA again, as conservator, they're in charge of all the GSEs financial statements ultimately. They're not electing for the PIK dividend, but we're actually drawing down on the treasury commitment to pay treasury the 10% cash dividend. That's known as a circular draw. If you were to continue this draw or this spiral into infinity, eventually that 10% is going to compound to infinity and you're never going to be able to pay that dividend, or you're going to keep drawing treasury funds until something changes in that regard. So what Ugaletti and DeMarco really came out and said was, hey, look, we need to solve this death spiral narrative. We need to solve the circular draw problem. And even though what's funny about this is Fannie ended it 2 quarters before the net worth sweep was imposed and Freddie ended circular draw problems a quarter before it was imposed, they still relied on this rationale to say it's in the best interest of the country to get rid of this death spiral narrative, because if it continues, the GSEs are going to go into insolvency again because of this dividend. And this insolvency goes back to that global catastrophes of all the foreign investors.
Thanks.
I have 2 questions.
Yeah.
They are kind of different and very long. So the first one, not in terms of words, but probably in terms of answer. So the first one's simpler. It's, you mentioned this $191 billion, right? Why did they need this? And like the reason, whatever the answer this is, will lead into the second question.
The drawdowns in total.
Was that just the drawdowns of the,
Yeah,
okay.
so you're booking all these losses, all these all these provision for credit losses, all these rep and warranty claims that were not shown, all these derivative losses are going to depress net income. So for example,
In many cases, they were accounting losses
yes.
rather than real losses.
Almost all of them.
Yeah,
So for example, you're going to have you're going to have all of these losses up here that are going to depress net income. And then eventually they all get reversed, like after the net worth sweep is closed.
Okay,
When you look at the derivatives, you're going to see the same trend of just losses and then a gain in 2013. When you look at the DTA valuation allowance, you're going to see that it got killed. The DTAs got written off and the assets go down early on in the conservatorship. And then in 2013, they just revamp everything. The difference with the putback receivables is they omitted booking these receivables. Like the GSEs had a protection that if originators sold them deficient mortgages, I could actually go demand that the originator repurchase the mortgage itself and make Fannie and Freddie whole. It's like very key protection, especially when you consider the amount of fraud and egregious underwriting standards that occurred from 2005 to 2008. The difference with the putback receivables is it was an omission of an increase in net assets. So it would be something like this. And then they only started doing the settlements with the big banks after the net worth sweep was imposed. Because if you did it beforehand, you'd increase net assets, you'd have less draws. But if we do it afterwards, we're going to ship all the gains off to Treasury.
so basically they needed to fund net assets because they were, what's it called? The value of their assets were going down because the housing market was going down.
Yeah, so if you think about net assets going off the deep end with all these losses, there's a negative book equity and Treasury plugs that gap
Got it.
to make it 0.
So then the second half of my question is, this came about with, you said FDR, right? So this is a government created entity.
Fannie Mae all the way back in the day, in like 1934.
Got it. That makes sense. I'm wondering, because 2008, at least from what I studied, was that 2008 was like a freak event where the whole housing market tanked. And according to Louis Ranieri, that would never happen, right? We'd never seen a complete collapse of the housing market. So I'm wondering if this was even, in your opinion, a valid business model to begin with. Because if I create a business, that the oldest example in the book is, I create a business that sells earthquake insurance to DC, I'll be incredibly profitable up until the point that
Until the
DC has the earthquake, right? So I'm wondering if this was a business that was ever valid to begin with.
I would say it is for 2 reasons. If we were to think about the business model of the GSEs in general, there's 2 components. There's the securitization components, which is getting the mortgages on your books and then immediately getting them off your books and ensuring against credit default. And then you'd also have the retained portfolio, which actually gets them into trouble, but not as bad as like other players really should be in trouble. And that's what the thesis would argue. And that fits on with your point. The retained portfolio is really going to hurt during housing declines. But the thesis would then say, it's gonna hurt, but man, all these other players, if Fannie and Freddie are hurting, all the PMI should have been wiped out, all the homeowners' equity should have been wiped out. The GSEs were in a third loss position when it came to that. When we're going to the securitization business, they had protections there as well. You charged the G fee, which was to cover administrative costs and expected credit defaults. And you're talking about Fannie and Freddie with employees that cumulatively have hundreds of years of experience, and Fannie Mae and Freddie Mac have decades worth of data to like actually predict these credit losses and charge an appropriate G fee. So if Fannie and Freddie were doing their jobs poorly, they'd actually go out of business. But I'd argue since how profitable they were, everything was going well up until 2007 when you started triggering all these non-cash losses.
I would argue that historically speaking, they provide a very important component to residential housing finance in the United States. And from their early history, post US Depression up into 2008, sort of a miraculous transformation that gave close over 2/3 of the American households the ability to own a home to a percentage that is not represented in Europe. Europeans don't have a similarly high level of home ownership. So in that respect, Fannie and Freddie has achieved its goals. The problem with the 2008 run-up, we had an anomalous, from 2003 to 2008, incredible run-up, a bubble, in real estate and relatively loose underwriting standards that got not only Fannie and Freddie in trouble, but also the private mortgage finance. Lehman, all those firms had a lot of like Alt-A and, high yielding mortgages. And then when the economy turned south, the home values could not be supported. The mortgages could not be supported. Then it was revealed that Fannie had, they had a certain percentage of bad Alt-A, but what was revealed in their loan portfolios, which was a much higher percentage, which then imperiled the bondholders, and there was insufficient assets to cover the bonds. And since many foreign countries own those bonds, that's when the Treasury stepped in.
Correct. And I'd even say we kind of conducted the hypothetical analysis that you were getting at, Cynthia. We changed the accrual net income. We made some adjustments and made it a cash net income. Fannie and Freddie, I believe, still needed funds in 2009. A lot of that is going to become real interesting when in the paper I talk about, there's this Bloomberg article that exists, but it's been scrubbed from the internet now, where Fannie and Freddie were forced to buy toxic assets from too big to fail banks and originating banks, and then immediately impair them on their books. Again, that article has been scrubbed from the internet, but it exists quoted in JSTOR and other articles. And one other comment I wanted to say to Professor Dong's point was, if you really think about a 30-year prepayable fixed rate mortgage security, that's an incredible feat. You're talking about half of an adult's life, and really the ability to extend out a mortgage payment to make it more affordable for people and allow them to settle, achieve the American dream, grow a family, build up home equity, and perhaps pass it on as inheritance. That 30-year idea is really a unique model because Fannie and Freddie.
And in many cases with a low down payment.
Yep, 3%.
Low down payment. And
Although
for-
I take issue with that. I mean, that's a story about kind of democratization of access to housing. If you look at the data, so it's housing that composes the overwhelming majority of household wealth in the United States. And the wealth gap, for example, between white and Black Americans is 12 times, whereas the income gap is about 2 times. So this was an avenue towards the building of wealth that was made available to only some segments of our society. So in a way, it was the opposite of democratization of access to these assets.
I agree with that characterization, especially given that Fannie was created in 1934.
Right.
And for those initial decades, if that's really when you get this model going, I'm in alignment with your view there.
So my question is kind of around politicization of Fannie and Freddie. So back in COVID, I know they granted relief to homeowners on payments of interest and principal. And then more recently, we see Biden asking lower rate homeowners to subsidize higher rate homeowners. And so kind of the way you frame a lot of this is, what's the exit strategy for common equity, junior, preferred, so non-government ownership, but as has been tossed around, the Fannie and Freddie do at the same time have kind of a very strong role that could be more public and government in nature as opposed to private. And there's a question of who should, he compares it to earthquake insurance, but I don't really know if I'd make that characterization for Fannie and Freddie. But at the same time, there's a question of who should be responsible for this. I think there's a risk the government takes over, then there's diminished focus on profitability, and that can be helpful for helping homeowners, but at the same time increases risk of default and could lead to bubbles. And then on the private side, there are also other perverse incentives. So do you see an exit strategy where instead of government exiting ownership, it would be public exiting ownership? Do you see some sort of structure moving forward where you
What
can
I
balance those
believe-
interests?
What I believe is gonna happen is at some point an administration is gonna wake up to. Let's say Fannie and Freddie make $20 billion a year after taxes, which I think if you take like through the past years from like 2019 to 2021, that'd be like the average. So that's after taxes, and you put a 10x multiple on that, so 200 billion market cap there. Well, Treasury can unlock 80% of that via the warrants. So that's what an administration could wake up to. To exercise that and go through the common equity, that's where the junior preferreds either are made whole, or what I think is going to happen, they're going to take a haircut because you got to negotiate things to get the ball rolling. The Trump administration made changes in 2019 to allow the companies to retain earnings, and these retained earnings are setting them on the pathway to eventual exit conservatorship because you need to meet regulatory capital requirements before that happens. I believe the Trump himself even wrote a letter saying like if he had more time for them to retain earnings, he would have already like released them via consent decree. So if you're looking from an investment strategy, any type of Trump or Republican administration, I believe would come in and actually like access those funds. Why Biden is not accessing those funds, that's a possibility as well. But I think Biden administration made a calculation that they get more benefit for whatever reason with them in conservatorship than them out of conservatorship and accessing those funds. The warrants also expire in 2028, if that's an important piece of information. That's your question.
I think you've sort of addressed it. I was going to ask about, you mentioned the net worth sweep can be turned back on when they
Yes.
achieve a certain level of, and I'm just, in light of our, forever ongoing budget crisis, do you think that's likely to happen?
I wish I had a magic 8 ball to tell you, but the official terms are once Fannie and Freddie hit a certain capital level, they're years away from achieving that just through retained earnings alone. It's a lot more complicated when you introduce the idea of a possible IPO and a write down of the senior preferred liquidation preference. But the idea here is it's either 10% of the liquidation preference, so similar to how the original term was, or a net worth sweep. So it's the lesser of the two. So if the liquidation preference is growing dollar for dollar with the retained earnings, and they still need another, 100 or so billion of retained earnings to exit conservatorship, that liquidation preference is going to grow to about 350 billion based on the 250 billion it's at right now. So then the next question you got to ask yourself is Fannie and Freddie going to make after-tax income greater than 10% of the 350 billion? Are they going to make more than 35 billion at that point in the future? It's possible. I mean, no one would expect that they're making 20 billion and making hella profits right now, but I don't have the full answer to that, but that's what I'd be betting on as well, assuming there's no IPO, assuming there's no political administration effort to change things up right now. Current status quo.
Couple questions. What is the junior preferred par and what's it trading at around right now?
So there's like 34 issuance of junior preferred securities. I want to say 17 and 17 for Fannie and Freddie. Some are issued at 25 face, some were issued at 50 face. Obviously the dividends aren't being paid at all and haven't been paid since 2008. They're currently trading at 8 to 9 cents on the dollar. Historically, they traded 20 to 50 cents. If you go look at a price chart, you'll see like when Trump got into office and people thought Fannie and Freddie were going to be released, a lot of funds came in and bet on it. A lot of funds came in and bet the stock prices up. During Collins, SCOTUS came out and that absolutely just killed the commons. We haven't discussed this at length, but there is an option for the senior preferred liquidation preference, not even to be written down, but to be converted into more common shares in addition to the 80% of the warrants, but we could save that for another time.
So I'm curious, so if the market is, pricing the junior preferreds at that.
Oh, I think the market's wrong, if that's what you're getting at.
Yeah, well, I'm gonna say, what are like the couple or few key points, I'm sure I have my head around everything, as to. What is the market thinking, and then what is difference in your thought process as to why you think, it might go up? in
The
future?
market's thinking the current status quo is not gonna change, that the companies are gonna just build retained earnings. To get to their regulatory capital requirements, the liquidation preference is gonna grow dollar for dollar. It's either 10% or a net worth sweep in effect, meaning less than the 10%. The market's probably betting on the GSEs not hitting that $30 to $35 billion net income at the time they reach those regulatory requirements. I think they're wrong. I think this can all be accelerated under a different administration, and you're betting on. It's not so much as an economic risk because these guys passed the Dodd-Frank's test. These guys are, immense behemoths making immense profits. They have a lot of protections. It's not really an economic risk, it's more of a political risk, and that's kind of how it's been. And I hope this thesis kind of highlights the political nature of the GSEs and what government wants to do with them, and kind of the third takeaway of politicizing their operations. I think the cow. Good. Thanks, guys.
At this point, the advisors and I should meet in private. We can do that here or have everybody else leave. If everybody wants to stick around, that's cool. We could all step outside for a second and convene and decide the fate.
That's gonna take a long time.
I think so. I mean, judging by the questions here, the comments during the questions, I think you're on a razor's edge here. They said, we'll find out in a second.
You may be here